14 public companies just announced that they're betting their futures on altcoins. And the stock market is losing its mind. We've got toy manufacturers promising to buy $1 billion worth of BNB, fitness equipment companies pledging $500 million for FET, and healthcare firms pivoting to become XRP whales. Now, this sounds bullish until you realize that these companies have market caps smaller than what they claim they'll spend on crypto. So what gives? Is this smart money finally rotating into altcoins, or dumb money's last desperate grasp before the music stops? My name is Lewis, and today we'll have all the answers. First things first though, you need to know that nothing in this video is financial advice. It's just educational content intended to inform you about the wave of US companies ditching dollars for altcoins as their Treasury reserve assets. If you enjoy our videos and you want to see more, then be sure to smash that like button, subscribe to the channel, and ping that notification bell so that you don't miss the next one. And so, Strategy's playbook has officially gone viral, but not in the way that you might expect. According to fresh data from Animoca Brands Research, we're seeing a surge of public companies pivoting to altcoin treasuries. And I'm not just talking about a little ETH to diversify. These companies are going all in, with some announcing plans to raise up to $1 billion specifically to buy altcoins. Animoca's new report identifies 14 public companies that have either adopted or announced altcoin treasury strategies. And before you ask, no, this isn't including the 148 public companies with Bitcoin holdings. This altcoin treasury trend is a completely separate phenomenon, and it is absolutely nuts. What's driving this altcoin treasury boom? Well, simple math and market dynamics. The Bitcoin treasury trade is getting crowded, and newcomers are finding it hard to compete with strategy for investor attention. So, enter the altcoin angle. Companies are betting that they could replicate Strategy's financial engineering with assets that have potentially higher growth ceilings and less competition for investor capital. The logic goes, why fight for scraps at the Bitcoin table when you could be the strategy of Ethereum, Solana, or even Hyperliquid? And the results so far have been explosive. Companies announcing altcoin treasuries saw their stock prices surge an average of 150.8% within 1 day of announcement. After 30 days, the report shows 226.5% average gains. One company, DeFi Development Corp, saw its stock rocket more than 9,000% within 50 days of announcing its Solana treasury strategy. And with billions of dollars of institutional capital poised to flow into altcoins, now is a great time to get set up in crypto if you aren't already. And the best place to do that is the Coin Bureau Deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cash back on deposits up to 75% on the top crypto exchanges, which will come in handy if you want to buy some of these altcoins that companies are getting into. Now, these deals won't be around for long though, so take advantage of them ASAP using the link down below or the QR code on the screen. And now, here's where things get truly crazy. These aren't tech companies, let alone crypto natives, making these moves. We're talking about companies from completely unrelated sectors. Fitness equipment manufacturers buying FET, tech companies that focus on eye health loading up on hype, toy merchandisers, why are they accumulating Tron? I don't know, but they're doing it. It's like watching your local dentist announce that they're pivoting to become a hedge fund. The geographic spread is also telling. While most are US listed companies, the report shows Canadian firms like HYLQ Strategy Corp and Soul Strategies joining the party. This trend is going global and fast. Each new announcement seems to embolden another struggling microcap to roll the dice on crypto transformation. Now, let's talk about the mechanics here, because this is important to understand. The core idea remains the same as Strategy's approach. Maintain a premium valuation where your market cap exceeds the value of your crypto holdings. As long as this premium exists, you could issue new shares at inflated prices, use the proceeds to buy more crypto, and increase the amount of altcoin held per share. Rinse and repeat until something breaks. And if you caught our video on SharpLink earlier this year, you'll know that they're the poster child for the altcoin treasury strategy, having raised $425 million to stack ETH. With Ethereum co-founder Joe Lubin as chairman and backing from Consensus, Galaxy Digital, and Pantera, they're positioning themselves as the strategy of Ethereum. But SharpLink's not alone. Sol Strategies in Canada has accumulated over 600,000 Solana. Interactive Strength announced a $500 million raise to buy FET, and SRM Entertainment wants $100 million for a Tron Treasury. The ambitions are massive, even if the execution remains to be seen. Now, these companies are exploiting a gap in TradFi, because while Bitcoin now has multiple ETFs providing easy exposure, most altcoins don't. Want institutional exposure to Solana or Hyperliquid? Your options are limited. These corporate treasuries are positioning themselves as the only regulated, publicly traded vehicles for accessing these assets. On the other hand, the SEC is up to its eyeballs in altcoin ETF applications right now. So how long this gap will persist is a key question. Strategy has survived the dawn of the spot Bitcoin ETF in part thanks to its innovative leverage structure. Whether its copycats in the altcoin space will be so resilient in the post-Gensler ETF landscape is somewhat questionable. Now, the report also highlights how accounting changes have helped this trend emerge. The U.S. Financial Accounting Standards Board shift to fair value accounting for crypto means companies can now book gains, not just impairments. This makes holding volatile assets like altcoins far more palatable from a financial reporting perspective. But let's dig deeper into what Animoca's research reveals about the actual execution. Most of these companies haven't actually purchased their announced amounts yet. They're trading on promises and capital raising plans. Nano Labs announced a $1 billion BNB purchase plan, but hasn't disclosed any actual holdings. Interactive Strength raised just $55 million towards its $500 million target. The gap between ambition and reality is massive. And the funding mechanisms are equally revealing. Many are using private investments in public equity, aka PIPE deals, issuing shares at discounts to institutional investors. This creates immediate dilution for existing shareholders, while providing the capital for crypto purchases. It's financial engineering layered on financial engineering, and that doesn't always have a happy ending. Now, the report does include some eye-popping numbers about stock performance, but let's face it, when you see a company stock jump 740% in a day, like HYLQ Strategy Corp did, you're not looking at organic price discovery. These are tiny, often distressed companies with minimal float and questionable fundamentals. Just like SharpLink, many of these firms were on the brink of delisting and bankruptcy before their crypto pivot. Upexi, Classover, Weebus. These aren't exactly blue chip names. Some had market caps below $10 million before announcing their altcoin strategies. The massive percentage gains often represent moves from pennies to dollars on virtually no volume. The report also notes that the announcements had, quote, no discernible positive impacts on the altcoins themselves. This is crucial. While company stocks are mooning, the actual altcoins aren't moving. Why? Because most of these companies haven't actually bought anything yet. They're trading on promises and intentions, not executed strategies. This creates an interesting dynamic. Investors are betting on the future execution of these strategies, creating what amounts to leveraged speculation on speculation. It's derivatives thinking applied to equity markets. You're not just buying altcoin exposure, you're buying exposure to a company that might eventually have altcoin exposure. What's even more telling is the sector distribution. We already gave a few examples of the types of companies creating these treasuries, but according to the report, we've got companies from semiconductors, online betting, fitness equipment, eye health technology, real estate SaaS, consumer brands, education tech, toys, solar energy, healthcare, transportation, and IT services, all jumping on this bandwagon. The randomness strongly suggests opportunism rather than strategic alignment. Take Wellgistics Health, a healthcare service company that suddenly wants $50 million for an XRP treasury, or Weebus, a transportation company that announced plans for $300 million in XRP. The disconnect between core business and crypto strategy is jarring. It's as if every struggling company suddenly discovered the same cheat code. Next up, the report highlights an important distinction from the Bitcoin Treasuries, which is the staking angle. This additional revenue stream from staking yields has significant implications for corporate treasuries. Staking creates multiple revenue streams: potential appreciation of the underlying asset, staking yields that can range from 5% to even 20% annually, and for some tokens, additional rewards from participating in network governance or liquidity provisions. It's a more complex but potentially more lucrative model than simply hodling Bitcoin. The report suggests that this could create a sustainable premium for these stocks. Investors will be buying into an actively managed, yield-generating crypto strategy. In theory, this should support higher valuations than a simple pass-through vehicle. But let's be realistic about the risks here. Staking isn't risk-free. There's slashing risk if validators misbehave, lockup periods that could trap capital during downturns, and technical risks from smart contract bugs or network failures. These companies are taking on operational complexity that strategy largely avoids. Plus, there's the opportunity cost. When you stake tokens, they're often locked for periods ranging from days to weeks. In the crypto market, being unable to sell during a pump or a dump could be catastrophic. The report doesn't address how these companies plan to manage liquidity needs while maximizing staking yields. And here's something else the report glosses over, which is the tax implications. Staking rewards are typically taxable events. These companies could face significant tax liabilities on their staking income even if the underlying token price crashes. It's complexity that Bitcoin treasuries simply don't face. And the technical expertise required is yet another hurdle. Running validators isn't trivial. It requires infrastructure, monitoring, and expertise. A toy company suddenly operating Solana validators? The operational risk is substantial. One misconfigured validator could lead to slashing penalties that wipe out months of staking rewards. Now, about that so-called infinite money glitch the report mentions. This deserves serious scrutiny because it's both the most alluring and the most dangerous aspect of this trend. The theory goes like this. Crypto goes up. Stock goes up more thanks to the premium. The company issues shares or convertible debt at inflated valuations, buys more crypto, repeats until fabulously wealthy, or spectacular implosion. Strategy has executed this brilliantly, turning a struggling software company into a $115 billion Bitcoin proxy. But strategy had first mover advantage, Michael Saylor's messianic promotion, and most importantly, the bet on Bitcoin during a historic bull run. These altcoin treasury companies are trying to replicate that success in a very different environment. The convertible bond math is particularly precarious. Strategy can issue debt at near zero rates because investors see it as a cheap option on Bitcoin with downside protection. But would investors accept similar terms for a company holding HYPE or FET? The credit risk profile is completely different. The report acknowledges this, noting that prolonged altcoin price declines could trap these companies. Unlike Strategy, which has Bitcoin's relative stability and 4-year cycle to rely on, altcoin treasuries are betting on assets that could go to zero. The leverage that amplifies gains will absolutely demolish equity value in a sustained downturn. The report provides detailed examples of how this works in practice, walking through scenarios where companies issue shares at 4x their altcoin holdings value. It's a beautiful model when numbers go up. But what happens when that 4x premium becomes a 0.4x discount? The death spiral would be swift and merciless. And let's not forget the dilution aspect. Every share issuance dilutes existing shareholders. Strategy has managed this by ensuring that Bitcoin appreciation outpaces dilution. But can a company holding HYPE or XRP maintain that balance? The math gets much harder with more volatile, less established assets. One fascinating section of the Animoca report explores the potential market impact as these strategies scale. They note there are over 53,000 public companies globally, suggesting a, quote, significant gap and, quote, large addressable market for crypto treasury adoption. I mean, think about the implications. If even 1% of public companies adopted altcoin treasuries, that's over 500 companies globally. The capital flows could be massive. We're potentially talking hundreds of billions of dollars flowing into altcoin markets through corporate balance sheets. And this could definitely create interesting dynamics. I mean, corporate treasuries aren't DeFi degens. They'll likely favor large cap and major altcoins with institutional infrastructure. This could accelerate the winner-take-all dynamics in crypto, where a handful of tokens capture the vast majority of institutional flows. And there's also the governance angle. The report mentions that corporate altcoin holdings could contribute to, quote, blockchain security and ecosystem growth through staking, but doesn't explore the governance implications. Corporate treasuries could become major players in protocol governance, introducing new stakeholders with very different incentives from crypto-native participants. And the regulatory implications are murky too. The SEC has been relatively hands-off with Bitcoin treasuries, and it now takes a much more optimistic view of altcoins and altcoin ETFs. But if these corporate strategies scale, it'll only be a matter of time until we see the first corporate altcoin treasuries collapse. And it's reasonable to expect increased regulatory scrutiny when that happens. One strong enforcement action could chill the entire trend. And consider the precedent this sets. If public companies can pivot to becoming quasi-hedge funds overnight, what's stopping every struggling microcap from announcing a strategic blockchain initiative? We could see hundreds of zombie companies attempting similar pivots, flooding the market and eventually triggering regulatory backlash. Now, let me address the elephant in the room at this point. Most of these companies are probably going to fail. The Animoca report is diplomatic about this, focusing on the potential upside, but let's be real here. The graveyard of failed crypto pivots is vast. I mean, just look at the list of companies making these moves. These aren't industry leaders adopting crypto. They're struggling businesses grasping for relevance. When your fitness equipment company suddenly wants to raise $500 million for FET tokens, maybe it's time to ask hard questions about the core business. Remember Long Blockchain Corp, the iced tea company that added blockchain to its name and saw its stock triple? Yeah, it got delisted. Now, Riot is a rare success story of a company that pivoted from biotech to Bitcoin mining. But while they did survive, dozens of imitators didn't. The successful players will likely be those with genuine business models beyond just holding the tokens. Sol Strategies, for example, is running validators, which could help. And perhaps if companies integrate their altcoin holdings into actual products or services, that would also be a help as well. Because as we have learned multiple times, pure financial engineering without underlying value creation rarely ends well. This altcoin treasury trend has all the hallmarks of a late cycle phenomenon. Small, struggling companies making desperate pivots, massive gains on minimal news, retail investors piling into penny stocks hoping to catch the next strategy. It's a recipe for tears. The report's risk section acknowledges market volatility, liquidity challenges, and the possibility of, quote, activist liquidation risk if companies trade at discounts to net asset value, or NAV. It also notes, quote, altcoin idiosyncratic risks, including lower liquidity and technical vulnerabilities compared to Bitcoin. The timing is also concerning. Many of these announcements came in May and June of 2025, years into a crypto bull market, with many altcoins already trading at premium levels. These companies are essentially buying the top with levered corporate structures. When the music stops, and it always does, the unwinding could be brutal. And on top of that, the lack of disclosure is another red flag. Many of these companies announce grand plans, but provide minimal details on execution, custody arrangements, or risk management. It's all sizzle, no steak. Professional treasury management requires robust controls and governance, qualities notably absent from most of these announcements. So, what's the takeaway from all this? The Animoca report paints a picture of a rapidly evolving trend that could reshape how corporations interact with crypto. The altcoin treasury phenomenon is real, it's growing, and it's producing spectacular short-term results in the stock market. But sustainability is the key question. Strategy's success wasn't just about financial engineering. It was about conviction, timing, and choosing the right asset. These altcoin treasury plays are trying to speedrun that playbook with much riskier assets. For crypto markets, this trend is bullish in the short term, especially if these companies buy as much crypto as they say they will. And even before they do, though, every crypto treasury headline is just more narrative fuel for the current bull market. And the legitimacy boost alone could be significant. When public companies are buying hype and FET, it's harder to dismiss these as purely speculative assets. But in the long term, execution will be everything. If these companies can navigate bear markets, manage their leverage responsibly, and create genuine value beyond just hodling, we could see a new class of crypto-native public companies emerge. If they can't, well, we'll add another chapter to the book of spectacular crypto failures. The most likely outcome is bifurcation. A handful of companies will execute brilliantly, creating massive value and establishing the playbook for others. The rest will fail, if not rug, leaving investors with worthless paper and regulators with new reasons to scrutinize crypto. Will we see an altcoin treasury on every corporate balance sheet? Probably not. But will this trend reshape how companies think about treasury management and crypto exposure? Absolutely. The genie is out of the bottle, and if some of these experiments do succeed, maybe we'll see larger and healthier companies integrating crypto into their treasury strategies in a less desperate fashion. And that's something that might be helped along by the wave of new crypto regulations that just got passed in the US. And by the way, if you're not up to speed on that story quite yet, you could check that out in this video right over here. Okay, that's almost all from me today. Thank you so much for watching, and I hope that you like what you saw. If you did, then give this video a like and possibly subscribe to the channel. That is all that we ask for in return. My name is Lewis. Thank you so much for watching. Again, you're awesome, and I'll see you in the next one.